does all the input for me. Now, the plan I'm going to show you right now is a couple that they gave me the verbal yesterday when they were in. I'll do paperwork next week with them. Randy built this plan. This is a lot of data. So this is the big plan you're going to see. It took him a little bit less than an hour and a half to build this plan. And this is a comprehensive plan I'm going to show you. So an hour and a half out of your time to do a plan, to be able to present to a client that is super powerful, it will really, really impact your business. So I'm going to share my screen now and make sure you can see what I'm going to show you. Can you guys see what I'm showing you?
Yes.
Okay, good. So this is what the plan looks like. So Dan and I have actually worked with Annuity Genius, and they have built the software for this. They support it. Dan and I don't support it, right? We use it. So this was for a client of mine I just wrapped up, and this plan, it shows you, it's going to talk about their budget, risk, fees, income, taxes, and legacy. And then we have a table of contents. We have budget, and then we have the risk. The current risk allocation is what their current risk is right off of nitrogen. With plan asset risk, our plan, our recommendation, what's the new risk? Summary of asset transitions. How are we going to transition the assets into the different asset classes, and what the risk acceptance is. You've seen that spreadsheet, but I'll show you today. Then we go through the fees. What are the current fees? And that's done by Y charts. And we also take their statements to determine what their advisor fee may be. With plan, again, is our plan. When we say with plan, that's the plan we're recommending. And then we do in the fee comparison. Income taxes and income plan overview, an annual income plan, guaranteed annuity income, monthly income plan, which includes the guaranteed annuity income, income tax and net monthly spendable analysis, and a summary income tax and net spendable analysis. So I'm going to show you those spreadsheets. Legacy, after the clients use their assets for income throughout their lifetime, based on extremely conservative rates of return for all their asset classes, we are showing them a legacy plan. So at any year for the next 30 years, how much is going to be left in the portfolio, in the annuity, in their bank account, and the value of the real estate. We have to show them that. You can plug your own numbers, but we're using very conservative rates of return to show them that you don't need high rates of return to leave a lot of money to your beneficiaries. And then we do all the asset analysis. We enter all their data into individual spreadsheets, which I'll show you. And then I do a hypothetical analysis. What if they did not use me? They used another advisor, or they did it themselves. And what if they were able to get S&P returns? How long would their money last based on the income coming off the plan? So I'm giving them a number of views of how this looks. This first 2 pages is just a disclosure document. I have my client sign it before I'll give them a plan. And it talks about what is this document? We explain it. The summary of the retirement income sources and factor. What our summary is that we're using COLAs, just disclosure data. Using an annuity as part of your retirement plan will give them the thought process behind why you should consider an annuity. There are no guarantees of investment returns. Again, this is disclosure to protect you and I, that if we're doing projections, we're protected here. Planning for retirement income and beneficiary analysis. Again, a disclosure on, hey, yeah, we're going to make some projections, folks, but don't hold us against you in the future if our numbers are off because we're just using projections. It's just a disclosure. A disclaimer, tax and penalty consequence of liquidating assets for annuity purchase. So if a client liquidates a non-qualified account and they have taxes, it's not our fault, right? Again, disclosure, disclosure, disclosure. So you don't have to read this to the client. You can just summarize it. Nobody has a problem signing it. It's standard disclosure. It's to protect you and I and to make sure the client's aware of how we built their plan. We're using their data. We're using their statements from their brokerage companies or their 401k plans. We're using, Social Security statements. It's their stuff, but we're disclosing it so that we don't have any liability. So I have them sign that before they'll get the plan. And the first thing we do is talk about the budget. And the single most important part of planning for retirement security when you're an income planner is the budget. So again, what we've done here is we've actually typed out how Dan and I explain the budget or any of these spreadsheets to a client. So you can skip over this when you are presenting it to the client, but if you're trying to learn it, you can read it. You guys can just read it and you'll know how Dan and I explain this, right? Also, when the client takes this information home, if they don't know what and they'll go on the budget. If they look at the budget spreadsheet and they understand it, well, they don't have to read all that stuff. But this is for you and this is for the client so that you're educated on our thought process. And this client budget had a big budget, 17,245. And again, we're plugging the numbers into the budget. This is the worksheet that is on the True Choice portal. You just plug the numbers in here and we go through it with them, and your budget 17,245. They were pretty shocked when they saw this. They thought the budget was closer to 10,000 a month, but it's actually 17,000.
Hang on, Jim, can I answer one quick question? Somebody had a question about the budget. So, Dixon, I think you asked, does the software have a fillable form to send the client for them to itemize their budget? So the answer is
yes. We have a spreadsheet, an Excel spreadsheet, and we send that to them, and they populate the Excel spreadsheet. Okay. Now we enter the data into this because the spreadsheet is separate than this. So they'll enter the spreadsheet, and then we got to pump the numbers in here.
Yeah.
Okay.
And so the Excel spreadsheet or a PDF of the budget, those are both available to everybody on the Dropbox. So if you need to know where that is, let me know. Okay. Thanks.
The budget. We spent about 5 to 10 minutes on the budget, going through it, make sure they've included everything. But they have a pretty steep budget, 17,000 a month. So then we go through a risk analysis. Again, we're describing assessing your current assets for informed retirement planning. We're talking about this stuff, evaluating potential losses during financial market declines. We're giving them how we're making our assumption. For example, each asset is listed out showing the individual asset value and how much you could potentially lose in each asset if we go through another financial market decline like 2008 financial crisis that saw the S&P 500 index fall by 53.1%. If an individual asset shows a risk factor of minus 45%, it means that during the 2008 financial crisis, you should have expected this asset to lose minus 45%. So $1 million would have lost 450,000, leaving you with a balance of 550,000. So we're kind of explaining to them the thought process here, and we're comparing it back to what happened in 2007, 8, and 9. And then we explain to them calculating total portfolio risk. The loss potential for each individual asset is then totaled to show how much your total portfolio could potentially lose in a financial market decline like the 2008 financial crisis, and then calculates out your risk percentage for your whole portfolio. If you have a $2 million portfolio that shows a potential loss of minus 800,000, your risk percentage is calculated as minus 40%. 800,000 loss divided by $2 million. Again, we're just explaining it to both you as an advisor if you don't understand this, but just as importantly, when the client takes this home, they understand what I'm saying to them while I have them in my conference room. They get home and they forget what I say, right? So this allows it to be reinforced. And then we're showing them their current risk factor. Your current portfolio risk is, as a percentage of it, is calculated at 29%. So we're taking their cash, their treasury bills, their assets under management, their retirement accounts, everything together, minus 29%. Which means on their portfolio, they would lose approximately $1.386 million if we have another 2008 crisis. And they would need a 40.8% rate of return to recover a 29% loss. Now, when you add minus 29% to 40.8%, if you made those both whole numbers, that's 69.8%. That's our own internal risk index. We don't want that risk to be higher than 20%. Ideally, we want it less than 15% when we remodel the portfolio. So right now, their risk factor is about 450% greater than what I want it to be based on how they're currently positioned. Then we go down here and this is just a summary here, and here's the detail. And on the detail, on the far left-hand side, it's each one of these clients' accounts. Judy's 401k plans has $1.615 million in it. At the bottom here, 34.7% minus, that's nitrogen's calculation. If we have another 2008 crisis, nitrogen is estimating that we'll lose approximately 560,000 of that 1.615 million. The next column is Judy's Thrivent IRAs, their ETFs, 1.5 million. They have a minus 38.4% risk factor. Now, we do this for every single account with nitrogen. If you want to lump it to one account, you can do that. But this is more meaningful. This is more powerful if you do it for each one of these individual ones. So you can go through here. She has variable annuities. Bill has a variable annuity, the risk factor. She has an HSA fund. She has a MIGA, which no risk at all, right? They have a money market account with 3 of these accounts, $103,000, no risk. And they have T-bills and in the bank money, no risk. So when we add all that up, go across this line here, that's where they get the 1.386 million or the 29% risk factor when we blend everything together. Because their bank money and their T-bills is part of their asset base. So we're going to blend all this together. So their current asset values, 4.785 million. If they lose 1.386 million, they're down to 3.398 million. They need a 40.8% rate of return on the $3.38 million to get back to their 4.785. So that's how we do it. And the risk factor or the risk index, our little index, is 69.8%. And again, I want that less than 20. Ideally, I want it less than 15%. So that's where they're at today. And when they see this, they're pretty shocked because they have no idea the level of risk they have. And the only reason the risk came down is because they had so much money in MIGAs, money markets, and cash. They have 500, 600. They had $1 million almost in cash type instruments. That brought the risk down. If not, the risk factor would have been closer to 40%.
Jim, Fred had another question. On a recent webinar that he was on, they suggested the approach of focusing on the 2008 was a scare tactic. How would you address this objection if it occurs with a client?
I've never had a client in my life say that, ever. But if they say that, I said, well, let's take 2001 and 2. The market dropped 53%. In 2007, 8, 9, it dropped 54%. Do you think the market could drop 50% in the future? And they said, well, I don't know. I said, well, if it's dropped 2 times in the last 24 years by over 50%, don't you think it could happen in the future? The answer is yes, it will. So all we're doing is giving you the data that if you experience another financial crisis or a tech bubble, like we've done in the last 24 years, where the market dropped more than 50%, you better be prepared. So if they did say that, that's how I'd answer it, in a nice way, of course. But I've never had anybody ask that question. This is not a scare tactic. Everybody that's in their 60s, right, have gone through those 2 periods of time. They're already concerned about it. They've already lost 30, 40, 50% of their money. They know what it feels like. So what we're trying to do is say, hey, folks, if this happens again, you better be prepped, and this is where you're at. Now, if you take this data and you really don't care, you don't need my firm. Go for it. Hold the handlebars when the market goes down and just hope like hell it's going to come back. By the way, I didn't mean to be rude with my answer at all. I'm just saying that I've never been asked that question, but if I was asked that question, I would go through it that way. Now, remember, this is meeting number 3. We've already taken them through meeting number 1 and 2 and showed them all that data, all those slides, different periods of time, the drawdown on the S&P, 13 years of no gains. The market drops every 5 years on average since 1929 by 39%. It takes a year and a half to hit the bottom. We've gone through all that data with them on meetings 1 and 2 a couple times. So they're acclimated now to this stuff here.
Dave asked, do you enter each position for all accounts or just put equity if it's all equities, etc.?
I didn't understand the question. What was that again now?
Dave asked, do you enter each position for all accounts or just put equity if it's all equities, etc.? I'm guessing
every position.
Yeah, I was going to say, I'm guessing you're talking about in the nitrogen software. They do every position. Dave, if you need help with that, let me know. There's some places can get automatically uploaded through nitrogen. Other times you can, I can show you a video that can help you upload it from an Excel spreadsheet if you have your positions in there.
We have one of our staff members, her name is Sarah, that do this for Dan and I. She cranked this whole thing out in about 22 minutes. She's fast. And this was a large, you can see all these different accounts, right? There's a ton of stuff in these accounts. She's very, very quick. So it's not the end of the world to do this. But if you want to consolidate everything in one account, you can. But this is just much more impactful. Because the clients, they're going to keep some of this stuff, right? And I want to be able to show them if you keep it, they may say, hey, I want to keep this account right with 190 grand. Okay, it has a 38.9% risk factor. You want to keep it or not? I can lower that risk factor less than 10. That's up to you. So I'm going to look at each account individually, personally.
Yeah, and once you do have all of the accounts in Nitrogen. It's really easy. There's literally a button where you click stress test and it will bring you this number. So I can help somebody navigate that if you need help.
So I'm going to go to the next screen. Now it says with plan asset risk. Now this is the plan I'm proposing to them. When we say with plan, that's our plan proposing to the client. Again, exploring the opportunities for enhanced retirement security. We're giving them a presentation behind what we're thinking. Insight from the 2000 financial crisis. We're describing it. You know, if it happens again, you better be prepped for it. Calculating your risk percentage. I'll read it to you. All the individual asset potential losses are then added together to show how much your total portfolio could potentially lose in a financial market decline like the 2008 financial crisis, and then calculates out your risk percentage for your whole portfolio. If you have a $2 million portfolio that shows a potential loss of minus 150,000, your risk percentage is calculated as minus 7.5%, 150 divided into 2 million. So we're just telling them how we're doing it, right? So their new risk factor is minus 7.1%. So if we have another financial crisis look-alike, rather than losing to $1.34 million, they'd be down 341,000. It is not risk-free. They would need a 7.7% rate of return in order to get back to even, and the risk factor is less than 20%. It's less than 15%. I have it at 14.8%. And then we do the same analysis. This is with the plan. When I remodeled the portfolio, I'm putting the $1.683 million and the $180,000 into the FIA. There's no risk on those first two columns. On the AUM, the next three columns is us managing money. I actually tripled the risk factor based on what the drawdown would have been in 2008 with the money management package we're using. I actually tripled the risk factor. I gave me a lot of room. I pumped it to 19.13%. I wanted to still make sure I could get less than a 10% overall risk factor by tripling the risk factor on the managed portfolio. And then, of course, on their T-bills, we kept that in place. We're not going to move that. On their MIGA, we're keeping that in place. And on Judy's HSA fund, we're keeping that in place. So again, $4.785 million. If they would lose, hypothetically, 341,000, that's a 7.1% risk factor. They dropped to 443 and only did 7.7% rate of return to get them back to even. Then the next session here, I guess I don't have the summary on this, but I have a summary document. I just didn't include it here. But if you look here, let me go back up here. I compare this. This is where you're at today. You could lose $1.386 million. That's where you're at today if you do nothing, which means you need a 41% rate of return to get back to even. That means if you lose that amount of money and you're paranoid because the market's going down, down, and down, two things will happen. You'll likely make a bad decision. You'll get out of the market at the wrong time. And because what you did in 2008, when this last happened, you had a lot less money than you do today. And you were going to work for another 15 or 18 years. Now it's 2024. And if it happens in 2025 or 26, when you're just retired, you'll start making bad decisions. You will get out of the market at the wrong time because you have a lot more money now and you're using those assets for income. So your psychology changes from what you would have done and stayed the course and wrote it down in 2008 to what you will do more than likely when you retired and drawn those assets down with income. So rather than losing $1.4 million, basically, the risk factor has dropped down to losing 341. Now you may say, Jim, I don't want to lose 341,000. That's fine. Tell me, and I will remodel your income plan, and I'll get that down to the hypothetical number that we're trying to achieve. Now I can't be exacting because I don't know what the market's going to do in the future. We're using on past performance of the S&P, right? But that's the only indicator we can use, and that indicator is one in which we feel really strongly about because the market is volatile, markets are irrational, and markets go up and down, and they always will. Then on this here, I'm showing them how we're moving the money. So on Judy Sutter 401k, it's at Fidelity today. There's $1.683 million in it. The $1.68 million is going to move into an IRA, and that's going to be a fixed indexed annuity here. On Judy's IRA, it's at Thrivent. That's the account number. We're going to move that into assets under management. We're going to form an IRA, and we're going to move it to AUM, where we're going to manage it. On Judy's Roth, it's at Thrivent, $194,000. It's in a Roth. We're going to make a Roth under our AUM platform. So we're just showing them. Now, what I do is I have a different spreadsheet that I start with here. And this should be on the portal as well. After meeting number one, when they send me their statements, I build this spreadsheet out so I have all their assets on one page. So if you see over here, this is the stuff I'm talking about. Here's their current annuities. Here's their current investments, or cash accounts, I'm sorry. And here's the current investments. I put all this on a spreadsheet, Excel. It takes me about 20 minutes to type it out. But now I have all their numbers here. And then if they have these annuities up here, they had these 3 annuities up here. I'm not going to move over here in purple is how I'm going to lay out the plan, because I'm dictating to my paraplanner how I want them to build a plan. So I build this spreadsheet. I put my little notes down here at the bottom, and I'm telling him what I want him to do. And then he's pumping the data into the plan I'm showing you. So the purple is where I want the money to go. So for example, that 254, it has a big surrender fee. I'm going to leave that alone over here in the leave alone column. These two have a surrender fee, but they don't have an income rider on it, and I can blow them away with income so I can justify it. I'm going to propose that I move those to the FIA column right here. This money here are their whole life insurance policies. I'm not going to get rid of them. I'm going to leave them alone. These bank accounts, I wanted to keep the $345,000 in the bank, so I left it in the bank column. We're not going to touch that. On that $1.683 million, again, that's going to be in the FIA column. I stuck it there. On these 3 accounts, I'm going to put it in assets under management. And on the HSA, I'm going to leave it where it's at. So at the bottom, we're going to manage $2.169 million in the annuity, $1.75 million in AUM. They're going to manage their bank money, and they're going to manage that column there. So this is really visual for the client. It helps them understand kind of how I've done it. And down here, I also populate what their current income is. He has a pension, 2 pensions, what their expenses are, and if they have a home, what the value with no loan. They have a second home. So this little page, I populate before meeting number 2. I go through it with the client so they understand, is this correct? Oh yeah, that's everything. God, I've never seen it on one page. That's cool. So this same information right now is this information here. We just written it out for them. Same data. So if you want my spreadsheet, I believe it's on the portal, correct?
Yeah, it's already on there.
Okay, good.
It's on the meeting information.
So we're just typing this out so when the client takes this home, they can understand where the money is today and where it's moving to. Now we get into the risk acceptance. This is the same risk view that I showed you a minute ago. This is the summary. So this is where they're at today. They have a 29% risk factor. If we have another 2008 financial crisis or another tech bubble, they're going to lose approximately $1.386 million based on what Nitrogen has concluded. They need a 40.8% rate of return to get back to even, and the total risk index is 69.8. My new proposed portfolios on the right-hand side, I reduced the risk down to 7.1%, losing 341, need a 7.7% recovery gain, and the total risk index is 14.8%. So I solved what I was trying to solve. I got the risk factor less than 20, ideally less than 15. But again, if the client thinks that 341 is too much risk, 2 things have to happen. I stick more money in an FIA or I stick more money in cash. That's it, right? No risk. This is the same data, but it's a different view. It's just a different perspective. So if you look up here at phase 1, how much could you lose? I'm going to go, whether you lost 50%, 45, 40, we plugged in 29%. So their plan, they would lose theoretically 29%. Their 4.785 million would drop by 1.386. They'd be down to 3.398. And all of a sudden, they'd have to go to risk phase 2. How much do they actually need to recover? Okay. I'm starting with 3.398. I need to make back 1.386 million to get back to my 4.785. I need a 40.8% rate of return to make up a 29% loss. And my total index is 69.8. That's where they're at today. And I dropped them down here to the blue. It's just a different visual than what I showed them before. I find this very helpful because some people look at things differently, and I want to reinforce it once, I want to reinforce it twice, and I want to reinforce it 3 times. I want them to understand the data. Then I get into the fees. We're using Y charts for the fees along with their statements to determine what their estimated fees are. So again, we're describing here what fees are. So whether you're doing this plan and you're not sure how we do this, or you give this to the client and they take it home, they understand how we've calculated these fees. Again, they have fees of 1.6% currently. They're paying $76,000 a year on their 4.785 million. They thought their fees were less than 1%, and they're higher once we did the analysis. This is the template that we use. Again, this is done, the data is provided by YCharts. There's some calculations that we're doing here as well and looking at their statements. So in this example, we could not find her internal expense at the 401k company. So we use a very low 25 basis points. Some of these retirement plans are 75 basis points, 80 basis points, 65. I couldn't find it, so I had to plug a number in there, and I explained to them that's a hypothetical number. Their internal mutual fund expense for that account was 37 basis points. That came from YCharts. And the interpolated trading cost on our spreadsheet was 92 basis points. So they're paying 1.48% in total fees, both visible and hidden fees, or $25,000 on that 1.6. So we do this for every one of their accounts. For example, they have 2 variable annuities. They had an M&E charge on that one of 1.5, an ME charge on that one of 1.2. They had a rider fee of 50 basis points on this one and no rider fee on that one. So when we added it all up, that's where we got the $1.6 million, or 1.6%, or $76,388 in fees. So that's where they're at today. They've already seen this before at meeting number 2 when I'm going through YCharts with them, but they're seeing it again in their plan. With plan, again, this is our proposed plan. We're describing it, and we dropped their fees down to 1.43% rather than 1.6%. So if you remember, they're paying $76,388 right now in fees, and we're able to drop them down to $68,410. This is a new plan. We go through the same analyses, and they're at $68,410. So we saved them a little money. Often we're more expensive. I would say in 70% of the cases, our fees are more expensive, maybe 75% more expensive. But we're disclosing everything for them. And I don't lose a deal because of fees, right? You lose a deal because of fees if you don't tell them your fees, and you lose a deal because of fees if you don't do all the work we do. But if you provide value and they see all the work we do, fees are secondary to them. They don't care really. Well, they care, but it's not going to stop them from doing business with you. Then we do an analysis here. You are estimated to save 17 basis points annually in fees, or 79.78 in fees per year based on our analysis. And then what we do here, this is their current fees, $76,000. This is the fees with the plan, $68,000. 17 basis point savings, 79.78. And then what's that mean over 5 years, 10 years, 15, 20, 25, and 30? You can kind of see if the fees never change, how much they could theoretically save in fees. After 15 years, they save $119,000 in fees. That is not included in their plan. That's just an extra, kind of whipped cream on the pie. It's an extra additive. We're just doing an analysis for them. Then we get into the income plan. We're describing the income plan. So this is where they're currently at right now. We have all the income sources here in the left, the column here that's all colored, and what their annual income today is, and what their monthly income is. I'm sorry, that's when we start income in 2025. So for example, in 2025, your projected gross income is $29,654 monthly, made up of the following sources. And so we're just describing it for them. And then we go down here and we lay it out for them in exact detail. At the very top in the gray bar up here, you're going to see how I applied the money. $1.98 million in that FIA, $180,000 in that FIA, $1.5 million in her IRA, AUM, assets under management. So I'm just laying it out here so they understand where the dollars are positioned. Starting in the left-hand column, we're going out to 30 years. I'm turning income on January 1st, 2025 with their plan. Judy's age, Philip's age. Philip's CalPERS, he has a pension, $97,886. I'm using a 1.5% increase every year for a COLA. So it's going up 1.5% in this column every year. Philip has another pension from a different job he had, so he has 2 pensions. I'm using a 1.5% COLA because that's what he gets. Judy's Social Security income, I'm going to start it on January 1st, 2025. I've done social security calculation, which I'll show you in a minute, to verify why we should start it then. I'm only using a 1.5% COLA on that, even though it's been higher than that. I'm just kind of dumbing the number down. On Phillips Social Security, same thing, 1.5% COLA every year. If we start income on her guaranteed annuity on January 1st, her annual income is $132,233 on $1.988 million of value. And Phillips is $12,000 on 180 grand worth of value. And then on the AUM, $1.54 million in her IRA, I'm assuming in my assumption, what if we get a 4% rate of return over a long period of time, and we take out a 3% in distribution? That's a 3%. So that 46,042 is 3%. The next page, 46,946, is 3%. And then the next column here on her MIGA, it's a 7-year MIGA or 8-year MIGA, I believe. And she's going to defer the interest, but when she turns 73 at 2033, I had to calculate her estimated RMD. So that 13,647 there is the estimated RMDs on that MIGA because it's in an IRA. And then on Phillips Inherited, I up here that $9,600, at $194,000, at $345, and at $240. I'm not even using it. I don't need it. I have enough income for them where I'm running calculations for growth, but I'm not using it in the income columns. So on the far right, next year they're going to make $355,847 in gross income. The following year, $359, $362, $366, etc. So they get to see gross income by income source for the next 30 years there on that sheet. Then I take them to this sheet. A lot of clients like to look at it monthly, same exact columns, it's just divided by 12. It's just monthly information. So the monthly income flow looks like this. Any money that we're managing, the annuities and AUM, will have that distributed automatically by the annuity companies, and the custodian will have taxes withheld automatically for them. And on Social Security, as you all well know, they can go on Social Security site, they can actually withhold federal and state taxes as well by entering that data. So this is their monthly data, 29 grand a month next year. And you can see each year how it's going up based on the COLA I'm using on his pension and the COLA I'm using on Social Security of 1.5%.